Good afternoon. This is session 14, and the title of the session is Financial and Fiscal Support for Fossil Fuel Supply. I'm your moderator for the next hour or so. My name is Ronald Steenblik. I'm the Special Counselor for Fossil Fuel Subsidy Reform at the OECD. We have a very distinguished panel here. There is one substitution. In your written program, we were to have Iveta Gerasimchuk. Instead, we have Nico Bower from the Potsdam Institute. He's joined by Aaron Atteridge, who's a senior researcher at the Stockholm Environment Institute. Sonny Mumbunan, I hope I pronounced that right?
That's correct.
Okay, research from the Research Center for Climate Change in the University of Indonesia. And finally, Patricia Pedra Coppe from the Universidade Federal do Rio de Janeiro. Without further ado, I'd like to invite Aaron to give his presentation on who is financing coal mining.
Okay, thanks very much, Ron. Firstly, I'm not a finance expert. I'm just someone who's curious about why there's so little attention, including in a conference like this, on the finance sector as a supply-side policy measure. And I might come back to that in the end. But I'm also quite happy to be someone who can bring after seeing all the coal mines and the oil platforms, I'm happy to be bringing the sandy beaches of the small island states to the Fossil Fuel Supply Conference. And if it's not immediately obvious why, then it will become, I guess. I guess as I said, we came to this question of who's financing coal mining because there's been some previous work done. You've probably seen it by Bank Tracker, looking at the role of specific international banks in the coal sector, by Influence Map, trying to work out who owns shares in fossil fuel assets, which is all really good work. But somehow we found can it be done in a way that's a more complete part of the picture? Because these are both sort of subsets of the big picture. And can it be done in a way that's sort of where the knowledge is current, so we really understand changing patterns in the finance sector and who's really involved? So this was sort of an experiment that I'm going to present to you. And it's an ongoing piece of work. I don't know if it's a failed experiment yet, but it's an interesting experiment. So our vision, just so you know, was to do something complicated, to be able to trace the financial flows from mine assets through different participating companies in those mine assets, through the corporate structures that are connected to those mining companies, look at different financial instruments, to look at all the way back to who's the beneficial owners of this, who's benefiting from this.
Is that worldwide or just for Australia?
The vision is worldwide. Okay. The reality is far from this vision.
Damn it.
Yeah, damn it. Yeah. But since I'm not a finance expert, and perhaps not a lot of you are either, I thought it's really quick to do a 30-second Mining Finance 101. So we understand perhaps what it is that we're looking for and why it's so damn complicated. If you're trying to get a coal mine financed, or any big infrastructure project, you're looking for two things: debt and equity. And we're not talking about the equity that we were listening to in the last session here. It's a different kind of in fact, it's almost the opposite kind of equity, if that makes sense. Your job is really to try to, as a mine developer, is to make sure you've got the right combination of debt and equity to be able to progress a project. Debt can come from bank lending, it can come from different revolving lines of credit, it can come from bonds issued on the capital markets. On the equity side, you have venture capital, you also have share offerings. So finance isn't just one kind of instrument, it's many. It's complicated because some of the instruments are combinations of both, and they start off as one and become another. There's royalty financing and streaming transactions, which are, again, in the mining sector, specific kinds of financial transactions that make it even more complicated to see what's going on. If you want to get a mine project off the ground, you also have to have things like hedging insurance against currency fluctuations. You have political risk insurance. These are all different financial instruments, and they all need to be in place to get a mine going. So ideally, you would try to, in this grand vision, we would try to piece together all of the ways in which different financial institutions are connected to this. You also have to have a whole lot of other things in place. For instance, offtake agreements for the coal before you get a mine off the ground, right? So this is just to say, if you're trying to understand the ecosystem, the finance ecosystem around coal mine assets, you've really got to be looking at all of these things and trying to get data on all of them. Just quickly, those yellow boxes, there was the session earlier today about subsidies or public finance. These are parts of that financing picture that public finance can sometimes come in and help fill in. But that's not what I'm going to talk about today. It's mainly the private side. Just to make it more complicated, you have project companies that are set up to run a mine, but in fact they're part of much bigger corporate structures. So that this debt and this equity, it doesn't have to be raised at the project level. And in fact, it's often not. It can be raised anywhere in the parent company structures. So if you think it's already complicated trying to get data at a project level, you then have to try and trace corporate structures and also trace finance raising in those corporate structures, and then also have a strategy for attributing any of that money to a particular mining asset or to their coal business. Where we are now is sort of partially way through the project. So I thought what I'm going to do is just run through a couple of interesting observations that we've come across so far and discuss maybe how it connects to the supply side debates. The first observation, this is a kind of corporate structure map for Glencore, which is one of the bigger diversified miners. The green dots, if you can see them that far back, and I guess if you're not colorblind, sorry about that. There are some green dots there for those of you who can't pick out the difference between red and green. But the green ones the red ones are different companies in the corporate structure of Glencore. The green ones are financial instruments that have been issued within that bigger corporate structure. They could be, probably a lot of them are bond issues. And this doesn't even get to the sort of lending instruments from banks yet. This is just sort of bond issues. And I think one conclusion I could probably say fairly confidently now from the work is, unless we come up with creative new methods and maybe work with different kinds of data expertise, it's going to be really difficult to bring transparency to financing of supply side assets. And so that's an invitation to any of you or anyone that you know who wants to jump in with a different way of approaching this from a data perspective, because it's incredibly labor intensive to go through and try to find this sort of stuff. And that's probably why the previous work has been kind of piecemeal. Okay, let's just take off the bond issues by the major international banks for a limited number of companies in this year or this small set of years, which is really valuable work, but it dates quite quickly. So that's what we were trying to overcome. This is the same company, Glencore, arranged more in the sort of legal hierarchy, just to give you a sense of the red dot second from bottom down there. That's where the Glencore coal is situated in the legal hierarchy. So, and you can move finance, corporations can move finance up and down this hierarchy through different structures. So the task is trying to trace that at a corporate level. For the major miners, this is what the picture looks like. Yeah, this is just where finance, for instance, could be raised at different levels. This is just a picture of how many coal mines Glencore owns just in South Africa and Colombia. So there's a lot of mining assets underneath this structure. And why this is interesting is because when you see the divestment debate, and you see pension funds like the Norwegian Sovereign Wealth Fund announcing they're divesting from coal assets, they usually have to define how they're going to do that, right? And I think the Norwegian, as an example, just one off the top of my head, I think they set the bar at it. We're divesting from companies with more than 30% of their revenues that are related to coal. When you have a highly diversified miner like Glencore, they're probably under that threshold, so they have so many businesses. But when you look at the scale of Glencore, they are implicated in so many mining assets. So the divestment, in short, you probably have Norwegian pension fund money in Glencore, who owns a hell of a lot of coal mines. Which is an interesting question for how does the divestment movement go a bit further than that. This is a smaller, sort of medium-sized company, just as another example. It's an Indian company called JSW. All you need to see again is that you have these corporate structures, but the most interesting thing here is here are the tropical islands. You have tax blocking structures there, which are basically offshore shell companies. So they're designed to limit the liability of the parent companies and to shield the way that finance is transferred through the system. And that, I'll come back to some reflections on that at the end, I think. Another observation is relates to a lot of the international banks have been making no coal lending commitments. So they're announcing that they're no longer going to be lending to coal assets. But in fact, and this has been shown before in the bank tracker work, but you can just see it in our data too, that probably the major role, or definitely the major role that banks play in financing coal mining isn't direct lending, it's underwriting of securities, in this case bond issues. So that still goes on, and that's not part of the no coal lending commitments because that just covers their direct lending with Glencore. In fact, this is, again, all the purple are bond instruments issued on behalf of Glencore. And you see this one down the bottom that has 6 different European banks that are underwriting that individual bond issue. And you can go through and look at this kind of data for any of the different bond issues and for any of the companies. And then, so you have a bank like Deutsche Bank that has announced that it's no longer going to be lending to coal assets, but they're underwriting, they're what they call the book runner or the organizer of the bond issue. So it's another way that financial institutions are implicated in facilitating the finance of coal assets. Jesse and I, we did a lot of interviews in South Africa with South African banks, Jesse Burton sitting here, to try to understand how they fit into the financing picture. And they're actually quite important for, I mean, I think this is going to be the case with domestic banks in any of the coal producing countries. They have a strategic advantage in the sense that their deposits are in the local currency, so they're not exposed to currency fluctuation risks. They also have a situation where you take an economy like South Africa, the banks there were saying, well, we have relatively fewer investment opportunities for all of our saving deposits. So we can't just back out of the mining sector because we have money that we need to invest on behalf of our clients. So in a sense, they felt, I think, that this, even from a business perspective, it's important that they maintain a relationship with the mining sector. Interestingly, we did similar interviews in Colombia, and off the record, some of the banks said, okay, maybe in a few years we won't be doing that anymore. But this is just a pie chart of Nedbank, one of the South African banks, to look at their lending in, I think it was 2017. And actually, the mining sector isn't a very big part of it. So maybe there is an opportunity there to put pressure on the banks or to have different kinds of conversations with the banks. In South Africa, you have some very specific financing structures that come up around Black economic empowerment, which is this policy agenda to try to bring in Black capitalists to the economy. And so I won't go into the specific financing strategies, but I think an interesting outcome of the BEE agenda, which is sort of a socioeconomic transition agenda, is that you end up locking in a new set of stakeholders with a very direct interest in the coal business that weren't there before. Yeah. And therefore, it makes public policy for any transition away much harder. So last slide, just some policy reflections on all this. I think, for me, I'm kind of surprised at how little attention is given to trying to understand the finance sector and their role, because I think it's a really effective site of supply-side policy. You see that in the Adani case as just an example. I mean, the reason it's effective is not only that it's one of the key ingredients to getting anything happening is finance. You don't have that. It doesn't matter what other conditions are in place. The project doesn't go ahead. But also because the finance sector is outside the domestic politics to a large extent. It's outside the political economy of specific sectors to a large extent. It has a different set of influences. And I think that's really, we spent the last 2 days talking about how difficult it is to make transitions happen with all the carbon entanglement and the political lock-ins and so on. But the finance sector sits in a different place. So I think it's a ripe target for a supply-side intervention. But the lack of transparency makes that really, really difficult. the those corporate complex structures and the tax blocking mechanisms have a number of perverse effects on transition. One is it's obviously depriving the state of tax revenues, which might otherwise help smooth the transition away from fossil fuel production. The other one is it could very well leave the state with huge environmental liabilities in terms of cleaning up the mines. You see, I read something like 40% of US mining companies are legally bankrupt. So, I mean, they're not going to be there to clean up, to fulfill their environmental regulation responsibilities at the end. Yeah. I think the stranded assets argument is weaker on the supply side for finance institutions, and that's mainly because the lending periods or the lending terms for mines is much shorter. The payback period is much shorter than for generation assets. So banks in South Africa were saying 5, max 7 years, that loan is paid back. So the kind of policy change risk that they're exposed to is over a much shorter time frame. So perhaps the stranded assets argument doesn't fly so well. Carbon bubbles has been covered enough, I think, but the last one was just, there was an article in the Financial Times a couple of weeks ago saying basically if you're an investor, if you're a consumer, you want to take individual action and you want to be an ethical investor, it's almost impossible to do that if you're investing in diversified fund portfolios. And that's just because of how pervasive coal mining companies are in those funds through structures like Glencore. So it's just a bunch of reflections based on ongoing work, and look forward to any comments or suggestions you have for making the analysis a bit more robust over time. Thanks.
So thank you.
I need a microphone.
Oh, that one doesn't work?
I have to see my slides.
Okay.
Use the pointer also.
Right. In any case, we'll certainly be looking forward to further fruits of your work. Yeah.
Okay. Hello, my name is Nico Bower. I'm presenting a study that we did with Christoph McGlade and Paul Eakins from UCL on the divestment and the green paradox effect. So this is a modeling exercise, and be aware, modeling, it's not, it's projections, it is not predictions, it is scenarios, it is not forecasts. These are structural models, not time series extrapolations or anything. And integrated assessment models are not econometrics. So what is the problem, basically? In the AR5, you have seen a lot of delayed action scenarios. And what these scenarios did is they fixed somehow, to some assumptions, emissions in 2030, and then asked, okay, in order to maintain the same long-term target, what is the future trajectory? And the higher you are in 2030, the lower you have to go. Yeah, as compared with the optimal immediate action case. So we have had here 2 cases. And this brings several problems with it, because you need a very high CO2 price in order to make the emissions go down that quickly. And that means you have also a strong drop of fossil fuel prices. This devalues resources, and this can lead to a green paradox effect and pushing up the emissions in the short term, because you have a front loading of fossil fuel extraction and the emissions would increase, yeah? If you do not maintain the assumption of fixing these emission trajectories. On the other hand, you would also produce lots of stranded assets. This is a devaluation of capital that was invested during that time period. And that could give rise to a divestment effect. So you would not invest in capital that is later stranded. And that would push the emissions downwards. You also have a stronger acceleration of the ramp up of low carbon technologies. Okay. What did we do? We used a series of carbon tax scenarios and imposed it on 2 models. They have different levels, a low, medium, and high level, reached in 2050, and we have different starting dates. They reach it with a 5% rate of increase. So it starts in 2020, 2030, 2040. And these dots that we have here are scenarios that were used in the AR5. So we are here in the ballpark of 2 degrees scenarios, and the Remind model has lower emissions than the TM-UCL model that we used. These models are both global, multi-regional, and long-term, stretching out to 2100. They have perfect foresight and rational expectation equilibria. What is this about? Comes at the very end. Both have advanced representations of fossil fuel resources and markets, detailed energy conversion sectors that are represented by vintage models. So we know all the investments in every period that are active in a future period in terms of gigawatts of capacities. We have price responsive final energy demands. So if prices drop, final energy demand goes up, and the other way around. Remind is a global general equilibrium model with a macroeconomic module also included, whereas the TM-UCL model is a partial equilibrium model. So it's only energy and resources. So what is the outcome? In the base case, you have for both models increasing emission trajectories, yeah? Driven by demand, basically, and that you have enough supply. When you now impose a policy of $100 per ton of CO2 achieved in 2050, but only starting in 2030, yeah, then you have a deviation from this path. So not fixed as you have seen in the previous slide. And you see here, it is below the baseline scenario. When we look at different variations of timing and the level that is achieved, then we see that for both models and all the scenarios, the divestment effect is larger than the green paradox effect. This is the net effect on the CO2 emissions. The Remind model has some little green paradox effects here, you can see. So what is happening on the fossil fuel markets? Basically, so you have coal, oil, and gas. These are the Remind results, the TM results. Tax starts in 2030, 2040. And here you have different tax levels and the year in the model. So you see that for coal, the most happens. Yeah? You have the largest reduction in prices and in quantity. And this is a simple divestment effect. For oil, in the Remind model, you can see a little green paradox effect because it has a lower price and a higher quantity. For the TM-UCL model, the lower coal use is combined with a substitution effect from gas. You use less coal, but more gas at higher gas prices. So a green paradox effect would be here. This is a simple substitution effect. So what is important now, and for this you do not need a model, for this you only need a piece of paper. You have here the carbon tax, and here you have the energy market price plus the markup from the emission penalty. And you can see that for coal, that has the lowest market price without a CO2 penalty, this increases very steeply, whereas the high oil price does not increase that much. When you look at the percentage markup, you see that at $20, $30, you already have a doubling of the cost of using coal, whereas with $100, this is not even true for oil. Yeah? Coal is much more responsive to a CO2 price. And this is why, the basic reason why these models phase out coal very quickly when you impose a CO2 price. Now, these are investments, differences to the base case, and again, both models and different tax levels. And you can see that even before the tax kicks in, we have less investments in coal And because this drives up the electricity price, more investments in the renewable technologies also. Yeah? So divestment in fossils comes with investments in low carbon technologies. Now the question with the perfect foresight and rational expectation equilibria. Lots of people laugh about it because it is so theoretical and all the microeconomists are a little esoteric, but this is very easy. And this is built in the model. So this is the project lifetime. And this is the annuity factor, so the percentage of initial investment that you need to recover in order to make the project not unprofitable. So when you're 10 years ahead of the carbon price and you assume that the carbon price shuts down your project, your coal power plant, then you have much higher capital costs that you have to cover. So this is the increase of the levelized cost of electricity production that you have to acknowledge. The model is built on this assumption that the investors see the CO2 price coming, and therefore they stop investing because it does not pay off anymore. So why is the green paradox so small? This is from a theoretical paper, Jensen et al. And this is the extraction path according to the hoteling model on which the literature of the green paradox is based. So you see a decline of oil use. That would mean our problem with climate change is solved because this is without any climate policy. If the CO2 price kicks in 2030, you have here this little effect. Now, in order to make this base case more realistic in our integrated assessment models, we introduce assumptions to increase the realism. And this is, we have multiple primary and final energy carriers. We have extraction costs. I will do it. We have decline constraints of active deposits. And we have adjustment costs for capacity and trade expansions. Yeah? And when you introduce all this, then the base case is already increasing over time. Yeah? And also, when you do this, the resulting divestment, the resulting green paradox effect is moderated. It is smaller. But if you introduce also the vintage capital of the electricity plants and others, then you get the divestment effect that goes in the opposite direction. So that you have lower emissions before the policy kicks in. So conclusions. The divestment effect prevails over the green paradox effect on fossil fuel markets for strong climate policies. So the green paradox effect might prevail in other situations. For example, I mean, here in England, you have the closing hours in the bars, and then people start to drink very fast before the bar closes. Yeah? So here is a counterexample. The conclusion is robust for two models, and we did also a broad range of parameter variations. The hoteling model, this theoretical construct, is hopelessly oversimplified, and it cannot be used as a reliable basis to discuss policies. Analytical models are incapable to represent at least to a sufficient degree the most basic aspects of fossil fuel markets. Numerical models help to understand complexity and can derive robust results regarding policy interventions. But results must be related to market fundamentals, like this CO2 price markup that I showed to you, like this capital cost recovery factor that changes with the project lifetime. And yeah, with this, I'd like to conclude. Thank you.
Oh, yes. Thank you very much, Nico. We'll move immediately to the next speaker, Sonny Mumbunan.
Thank you. Good afternoon. So I'd like to present. This is a paper with the more or less same title, Stranded Asset, Carbon Risks and Coal Mines in Indonesia. So the idea of putting carbon risks here is basically is not really discussing the risks, but more on differentiating self than say stranded asset discussions in the 80s about or induced by, for instance, regulatory change. It's a work by myself and two colleagues at the Research Center for Climate Change at the University of Indonesia. There are a number of motivations. I mentioned two of them. In the context of Indonesia, there has been no study valuing stranded coal assets, so I think it might feel the need for information because Indonesia is one of the world leading coal producers. There have been some works on or related to Indonesia, but it is mostly part of cross-country studies with interest in comparing these countries. These are important studies, of course, but then it seems to be lacking in terms of country context. And perhaps in part because of that there is a tendency that the studies tend to assume, direct or automatic stranding because of carbon risk or price international price decrease. In this presentation, I will argue, there is it's not really direct, but that there's some efforts that make at least there's market for coal. The approach is we use simple economic approach. Sorry. Yeah. Yeah. So basically we use the marginal cost curve to establish a supply curve, and then using this information we look at how, or by assuming a demand shift and differences in price before and after demand shift, and then we can calculate the stranded value for coal. I mentioned about price decrease here. We are using the 2014 coal price, which is also decreasing as shown by the trending line, and this is because of the choice of the year is because we are using the 2014 financial statements information from coal companies. These are the value of stranded assets with different assumption on discount rate between 6 to 7, which is usually used in the literature, different lifetime assumption, and different assumptions on price changes from the base price. We like to use these to reflect on three, so to say, issues here. One is on the increasing domestic consumption to cope with stranded assets. Second one is on stranded assets and state revenues, which have also been discussed in another sessions yesterday and today. And the third one is on the Indonesia's contribution under the UNFCCC and Paris Agreement. I mentioned about the possibility that it's not directly stranding is because, for instance, in Indonesia, coal companies can, among others, negotiate with the government for higher coal price than, say, the international price. They can also request for support or price subsidies so that they keep producing for domestic markets. This is of course different when international price is high, where coal companies would love to export as much as possible, even to the extent that they want to sort of overlook the domestic market obligations. There have been also so-called mine-mouth coal-fired plants, so electricity plants fired by coal, but then using supply or coal in the proximity to the mining areas. And this is also part of the government project, and some of the coal companies, they also turn themselves into also energy coal-fired plants here. Even if this is more costly to electricity customer, and it poses cost to society, be it environmental or health, this hasn't been part of the conversation. So they want to increase. They want to keep producing, even when the price is not economically feasible or viable. The stranded asset and state revenues. There's always a potential reduction in revenues from coal because of the carbon risk. But in terms of in Indonesia, the revenue collection is basically low. Just to mention one example, the so-called non-tax revenues, which includes mining royalties. The collected amount and the potential is like only half. So half is collected, and the potential based on the World Bank, the recent World Bank studies. So when it comes to coal revenue reduction, you have of mixed feelings on the extent and magnitude of the impact. Because of the lower revenues from coal rents, then it's supposed to provide the state incentive to just leave coal in the ground, because the revenues are not as much as expected. The one of the reasons behind the mine-mouth coal-fired plant is the claim that they also provide revenues that also might offset the costs. But if we consider even like indirect costs or future fiscal risk, then in addition to already low sort of rent capture or collected revenues, and add to this, and there are not much incentive for the state to collect more revenues. The last reflections is on the Indonesia's national determined contribution, or the intended nationally determined contribution in its earlier version. If we look at these, or the document supporting this submission, then we see, for instance, clean coal technology, and also the mine-mouth coal-fired plants, which also sort of posting questions on the credibility of Indonesia emission reduction plan in terms of consistencies, between reducing emissions, but its energy sector still rely much on coal, and in terms of power generation, it will still dominate future power generations in Indonesia. The way NDCs and INDCs before were being designed were in large part dominated, or motivated more by economic concerns when it comes to energy production than, say, evidence-based need for emission reductions. Because coal is so important to the energy production, and it's also, putting the planner, so to say, in difficult or in somewhat conflicting positions, whether to reduce emissions from coal, or putting some limits on coal production, or concerns related to growth and job creations. The NDC needs still to factor in some of the carbon risks and its fiscal implications. Even though I mentioned on revenue side, there are still some discussions and more empirical works to be done in this area because of the sort of offsetting effects on revenue, but also on expenditure side, I think that the NDC need to consider more on the especially when it comes to stranding assets in the future, and perhaps lock-in effect of investing in coal-fired power plants. I think I'll leave at that. Thank you.
So, last but not least, we turn to Patricia Pedra. Okay, you have the microphone.
Okay. Thank you. Hello, so now I'm going to talk about fiscal incentives for oil business in Brazil if they're really necessary. My name is Patricia Pedra, and this paper was also co-authored by Alexander Sklo, who's just sitting over there. He's my professor. If I do something wrong, he's just going to correct me right now. Okay, so here. So, of course, you all know why this is all important to get the energy prices right. It can have impact on global carbon emissions, reduce global carbon emissions. It can also reduce local fuel, local air, improve local air pollution, increase GDP, and also has an impact, a positive impact in income inequality. So this is just to give you a brief introduction. Why are we doing this? So let's go to Brazil now. And then we go to Brazil. Brazil is in South America, and it's the largest country over there. And the oil production over there sits all offshore. Basically, almost 99% stays over there. And in 2007, we have a very big discovery of oil called pre-salt. I don't know if you're all familiar. So basically, the oil in Brazil was, prior to that, was all founded in the post-salt. So the salt is all this large layer here, and then you have everything above that was the post-salt. And although the discoveries we had so far were done at that layer, and there were some geological thoughts that you could have oil below the salt, but it was something really kind of impossible to happen. But anyway, it happened. It was not impossible, and they actually found a play that could be as large as the one they have above. Okay, so in terms of volumes, it added about 176 billion barrels of oil in terms of resources. And the production in Brazil from 2007 increased from 1.8 million barrels a day in 2007 to 2.6 in 2017. And half of this production is now coming from the pre-salt. So why I'm talking about pre-salt is because the work I did here was actually using some pre-salt fields to assess whether those fiscal incentives are necessary for them. So how was this work done? So we got this input from the pre-salt. We have different size fields, and in terms of ultimate recoverable. And then we have a bit an economic model that has the fiscal terms for the pre-salt in Brazil, which is a production sharing contract, which is a regular production sharing with some exceptions because it has royalty and CIT. And then we assessed the tax incentives. The tax incentives in this case is called Repetro. Repetro is a tax exemption that was created in 1999 for when the industry was being opened to the market. So it was created over there to to equalize the costs, because it gives some tax exemptions to some oil items, FPSO and subsea items. So,
sorry, these import tax exemptions, or they VAT
imported,
exemptions?
VAT, combination of them. And because we have different in local, state, federal. And then we compare the results with and without incentives against an industry IIR. Based on some financial data. And we have a base case and we have a sensitivity case. The sensitivity case also took into consideration some learnings that the industry had, which made the cost reductions. So let's see the results. So the first result I got was on the base case, and I use a 20% profit oil here. So profit oil rate is something you can offer. So the government has the minimum profit oil you should bid for, but you also can, that's a bid parameter. So whatever you offer is one who offers the most will get the bid. So this is the minimum, this is the average minimum set by the government. And what we can see from here is that actually projects, so this is the results without incentives. So above 2 to 3.5, I have three different prices, 50 to 70, and we actually today, I think the oil reached 81, so those are all above the actual one, all below the actual one. So above 2 billion to 3.5 billion recoverable cases, they don't need fiscal incentives. So if they get fiscal incentives right now, those incentives are actually not being used as an incentive because they are profitable anyway. It's just more money for the contractor. So I actually did, but as the profit oil is something variable, so I took the average max offered at the bid rounds, and I put here to see if using the fiscal terms you could get out, you can reduce the contractor's profit. So that's true. The profit oil mechanism can get some profit out of the contractor, but we still have some windfall profit left over. And if we look at the sensitivity, so here we go to 3 to 4.5 project size. But if we go to the sensitivity case, which has a cost more close to the reality right now, then we go back about to the 20% in the base case. So right now we have from 1.5 to 3.5 million barrel projects ultimate recoverable with as a threshold. So they are profitable above those size. So if we look at the results with the incentives, so what we see right now, so those are the base case and the sensitivity case with the max profit oil rate. So you can see that the IIRs can get to 25% in the base case and 35%, so way more than the 11.3 that we have as a threshold for the industry. So all this money is being left for the contractors, and it's not actually being used for the government as it should be. So in terms of conclusions here, I actually have 3 conclusions, and I think I'm speaking too fast. So we actually have ineffective incentives. So if you look at some size projects, of course the small ones, no, but you have some large projects, they really don't need those incentives. And we have actually calculated a break-even price for 5 billion barrels and a 40, it's actually $40 per barrel. So the PSC term, so the variation on the profit oil rate can get some adjustments, and you can also give incentives to small ones if necessary, if that's the case. But you can take some profit from the high ones, but you cannot take all, so it's not all the solution. So you actually leave with left with some extra rent, and you have to think what are you going to do with this extra rent. So maybe it's not a point of putting this taxes back, but actually thinking which is the best tax to put in this industry. So we can take like a carbon tax and put on renewables. Because I think the best thing here is to give alternatives, because you cannot just say stop oil, but do what? So you actually give alternatives. So if you take the money that is being generated here to put on renewables, to reduce the dependency on fossil fuels, then you can actually create some opportunity for the country. So on future study, that's what we're thinking we're going to do, to think about what we're going to do with the windfall profits generated in Brazil, and also think about the threshold of IIR, because Petrobras is a major company in Brazil, and they have been through different situations, the financial, so maybe the IRR is not exactly as the industry, so it might get a different one, so it's something for future discussion. That's it.
Thank you. Thank you very much. We had quite a diverse set of presentations, all pretty meaty. I guess the common theme was basically how are these different coal mines and oil plays being incentivized, and what would be the effects of removing some of these. But let me throw it open to the floor, because there isn't a whole lot of time left. I see a question over there, first, second, third. Oh, okay, so, all right.
Jan Steckler, MCC, thank you all for your nice interventions, very interesting. I have a question for Aaron and one question for Sonny. Aaron, maybe I got this wrong, but as far as I understood it, you were specifically looking into the private finance of coal mining, and I was wondering what is actually the share of private finance in coal mining, and what is the share of state-owned enterprises or other state-related hidden financing schemes? So what is the importance of that?
Do you mean globally or a particular country?
No, I mean actually on a global scale. If you have examples for particular countries where it might be particularly interesting, would also be interesting to hear your comments on that. And Sonny, you were talking about the coal revenues, and as far as I understood, the coal revenues in Indonesia are partly shared between the national and the local governments. Mm-hmm. So could you maybe comment on that? Because the implications might be very different here, and also, as far as I understood, this is a major effort of the Indonesian government in terms of decentralization, etc. So it would be interesting to hear your comments there, because you refer to the state in general, but I understand this might have different implications.
Thank you. Question for Aaron about the financing of the coal mines. So you mentioned that divestment might be a good strategy for starving these coal mines of financing. Thank you. But I guess the complexity of the different linkages that you showed makes me slightly wonder whether that would actually work. So I was wondering if you had any concrete examples of where divestment focused on one particular project may have been effective.
Thank you. Ipek Genç, ODI. Thanks for the presentations. I've got a question for Patricia. So that was a really interesting perspective, actually, because in many countries we see problems around support to prop up companies that would otherwise fail because they wouldn't be profitable at all. So it was really interesting to see your perspective. But what are the implications from a climate sort of angle? Is there any sort of public debate around it, or in terms of your analysis, like what are the next steps in linking to the support and the climate aspects?
Okay, well, we'll start there. Aaron, I guess we'll go on this.
Sure, okay, thanks. Jan, in terms of your question, the distinction we make is rather than looking at public either subsidies or what did you call it in your session? Public financial support, the sort of subsidies plus regime, which is certainly a source of finance for a lot of projects in different countries to deal with different commercial or political risks. But it's usually an add-on to a much bigger private finance picture. So I don't have figures of like 80%, 20%, but I would say overwhelmingly finance comes from the private sector, from capital markets, from venture capital funds, from shareholders. And the role of public finance is usually just to get it over the line, right? Okay, Sheila's shaking her head. That's good, because I was going to actually. Okay, good. Yeah, well, no, you should throw it in now, because I'm just telling you that's the only distinction we made. We sort of said, okay, let's put all that aside. Let's just try to track where the private wealth is coming from, to the loans, the equity investment, and so on. And in terms of the question about divestment as a strategy, I think. I mean, Frank's a better person to talk about this, but the Adani case in Australia was, so far, it has certainly delayed the construction of a very large coal mine, largely driven by, you know, the difficulty in getting finance, because a lot of financial institutions were pulling out for different reasons.
Seems the one remaining hurdle to it,
yeah,
but quite possibly insurmountable.
Yeah, and that is a case for me that totally demonstrates why targeting the finance sector makes a lot of sense as a supply side policy, because you have there a political environment that was incredibly supportive of the project, but you just kind of subverted that whole process and said, well, okay, you can get the social or the regulatory license to operate, but if you don't have the money, then you can't go ahead.
So that was quite surgically targeted at particular institutions which were known to be financing that coal mine. So
was that how the campaign? I suspect that's how the campaign rolled out. Yes. So yeah, exactly. And in terms of the role of divestment generally, it's not always going to be starving the projects of capital, because you have a sort of, I don't know if it's what you call a leakage effect, but you know, one financier moves out and another one's willing to move in, and you certainly see that. But what happens is, as the big financiers move out, different kinds of financiers move in, and they're more expensive. So you're at least raising the cost of capital for the same project, which has a helpful effect.
Before I turn to Sonny, we have a two-hander from Sheila. No, I think it's good, because to follow up on Aaron's comment about the share of different forms of financing.
I mean, it's difficult to say. The data is not great. So, but I would just say I don't think it's not a small amount of public on top of a big pot of private. The indications are usually that sort of state ownership at the level of state investment in oil and gas production, coal mining, fossil fuel power is usually around 7 to 80% public. But then you have loads of questions, right, about there will be private bondholders in these public companies. There's a whole, there's layers upon layers about where they come in. But just that the majority is public, and what the IEA just said in their latest World Energy Investment Outlook, and this is boring for people who were in the last panel, but I said it at the opening of that, it's rising. So the state share of investment is rising.
Include, I mean, if that's a global figure, it includes places like India, where the coal sector is public, rather than if we in fact, in this study, we just tried to test it by looking at South Africa just as a methodology. And you have a different structure.
Yeah, and I'm talking when you look globally, and we've looked at the G20, and it's the vast majority is state owned and state investment.
It would be great to unpick that.
Yeah, I just also want to clarify, because these are confusing terms sometimes. By public, we mean actually state owned, not publicly traded on a stock exchange, or private as in not public. So anyway, thank you for being patient, Sonny. Respond to the question about Indonesia.
Speaking of public, and I'll use specific also definition of public finance here to respond to your question. So there are two areas that two different areas. I was speaking on the collection, the revenue collection side, while you were referring to sort of the transfer side. One, it is being collected, and then it is, shared through revenue sharing arrangement or intergovernmental fiscal transfers to subnational jurisdictions. So I was focusing more on the revenue side and the value, because that's more straightforward. But once it's being collected and it is distributed between the central government, like 20%, and the remaining 80% for provinces and districts. And I'm speaking of two instruments, a land rent and royalties, which to some extent at the district or provincial level has different arrangement. You have 1632, another 32 for producing districts, for instance, within the producing provinces. But again, these are different than what we discussed. So I was sort of at the upstream side, the revenue collection side, while the revenue sharing arrangement sort of somewhere in between before the expenditures, let's say. But thank you for asking that.
Patricia?
Yes. So on climate policy in Brazil, so this tax incentive that I was talking about is actually part of set of measures that the government took in actually the opposite direction, and I think it goes more towards what Nico just said, because I think they saw that the climate change was coming, and then okay, let's produce everything very fast so we don't lose the track in terms of
we recall the bar analogy, right?
Yeah, so I think there was a series of measures that actually incentivates the pre-salt, and most of the investment, not most, but some of the investments were already taken, so that production will actually come. But I don't know if some of Roberto or Alexandre want to talk about the NDC, the Brazilian NDC, because from my point of view, there was not a specific commitment from Brazil to reduce oil production. It was other measures, but not oil production. But I don't know if you want to comment about that for the climate policy for Brazil.
The target related to liquid fuel, oil fuel production, and the only target is the expansion of the liquid biofuel production, which is the major target, specific target of the Brazilian NDC. In terms of oil production, most of the Brazilian oil production will be exported. So Brazil will become one of the major oil exporters in the next 10 years, perhaps 2.5, 3 million barrels per day being exported. And Brazil became around 4 million barrels per day of production, like Iran. And most of this coming from the pre-salt fields. So the point is, this fiscal exemption is not needed for these oil fields. Most of these oil fields do not need this fiscal incentive. So Brazil is transferring the windfall profit from society to the oil companies. This is the main message of this study.
I'd like to ask a very quick question on that. If Brazil's a lot of Brazil's approach to reducing emissions is based on the further introduction of biofuels, couldn't one not make an argument that, well, so essentially what that means that you have more of your oil production to export, so the net effect on global emissions is zero?
You want to add something?
Let's say, in fact, it's not true that most of the reduction in Brazil will come from biofuels, simply because...
Sorry, it's part of it, yeah.
It's a small part because basically biofuels is already the baseline in Brazil. That the important issue here, let's say, is that, as Alexandre said, by having these fiscal incentives, basically you may produce more oil than otherwise, because some oil fields that would not be profitable with a normal, let's say, rule of the game, in that case, they will be produced. And for sure, as Alexandre said, let's say you're going to be exporting more oil, but it does not mean that by exporting more oil, you are creating demand for that oil. So chances are that the oil from Brazil will, let's say, replace other oils that are of lower quality and more expensive to produce, mostly oil from Venezuela and from Canada. In fact, our models, our integrated models, show exactly that. By increasing oil production in Brazil, we're replacing oil from other places where that oil is more expensive to produce, because demand for oil is given.
Okay, we can maybe have continue that offline. I see Iveta. Anybody else want to ask questions? We're allowed. Harrow says that we could continue to 4:05. So if there are enough questions. But.
Thank you for the presentations. I just have a comment, especially for modeling of kind of tax impacts in Indonesia and Brazil, but maybe also for South Africa. So when it's important to look at taxation of production in isolation, because it's kind of a debate in itself. But the reason why, for instance, in Indonesia you can't tax coal more is because the government is keeping electricity prices very low. And it's capping the price for coal producers selling coal to electricity power plants. And 2 sessions ago, Ron gave an example also how it can work the other way around. So if utilities are required to purchase coal at a higher price, then it's a subsidy to producers. So just the implications are that these assets can still get stranded if the global kind of push for higher prices for consumers and internalization of externalities, such as air pollution, into those prices happens, then it's not the single factor in the analysis, looking at how it is taxed now and what are the incomes now. So you have to look at the consumption side as well, and that's where consumption and production are linked for fossil fuels.
Another question? Does anybody want to respond to that, or don't have to? But
Just a short response. Thank you. If I understood it correctly, I fully agree on the consumption side, and in the case of, say, palm oil in Indonesia is affecting at the moment. But whether it's applicable to coal, then I'm not really sure. And that's also part of the argument because of the domestic market. It can create and then even impose price and, not economic, of course, but then it is, it's a subsidized price and even above the baseline coal price. So I see the idea behind consumption, and that's important, of course, but I'm not really sure when it comes to coal. But I can clearly see, for instance, in terms of palm oil production, and companies really respond to changing of preference of consumers, for instance, in Nordic countries, for instance. But for coal, so.
I don't see any other. Are there other? Oh, okay.
Thanks, Cleo. This question is for Patricia as well, and it follows up on the question that Roberto was responding to. So you made it clear that much of that pre-salt production is profitable without the subsidies.
So the big fields.
Sorry?
Big fields. Yeah.
Yeah. Big fields. And then of the other fields, how much of that is actually tipped into profitability by the subsidy you're looking at? And also, are there other forms of public support that end up being important, maybe investment in port facilities or something, that are also there and could be important, but that aren't taken into account here?
Yes, there are actually other incentives. They're actually not being taken into account here. In terms of local content, we had more strict local content rules, which were reduced. And even on this Petro reformulation, which is the tax incentive, there is being taken into account here. I just took the tax itself on the goods. I didn't take other things that were actually some acceleration, depreciation. There are some other things that could be included for future studies as well. So in terms of the small ones, we can actually take a look. So if we look at the base case, depending on the price, you can get some through the threshold here. Sorry, here. Sorry. Yeah, so depending on the price, you can actually get some through the threshold here. And if we look at the sensitivity, you actually can get more. And then the colors changed. Yeah, but this is the green. So you actually get a bit more if you look at the sensitivity, which is more closer to the reality. So maybe if they don't, and this is without the incentives, actually. So, but this is with 52. Because for the small ones, I really think we should consider the 20% profit oil rate, because if they are small, people will not bid for the highest. So if we look to this one, we would not be fair to the small ones. Okay, but indeed, there are cases that are actually being just being produced. The small ones are just being produced because of the incentives, if that's the question. So that's indeed the case.
So
There's probably some.
Several thousand million barrels.
Yeah, we actually don't know, because this is those are independent cases that are just representative cases. It's not actually the cumulative volume. It's not. Okay.
Okay, but, and then we have to wind up.
As Patricia said, these are representative cases, but most of the Brazilian pre-salt oil fields are large oil fields. So this means that by one side, for these smaller fields, they become profitable. But for the other side, and this is more important because most of the volume comes from the large fields, this means windfall profits. I think the mechanism that we should explain that is the oil companies comes to the Brazilian government, but it's the same for the Mexican government. The real battle, the real war of thugs is let's freeze, let's fall the fiscal rents, and then you become an area attractive for private investment. So if you don't do that, I will go to Mexico. But if Mexico don't do that, I will go to Kazakhstan. And depending on the government and on the moment of the government, this will be done or not. So the real war of thugs is between the government, how the government can enforce its position, and the private oil companies asking for more and saying that, oh, this would not be profitable with 35% of revenue.
Gaming the expected profit.
Okay.
Yeah, windfall profits.
Thank you very much. We now have a coffee break, and then the closing session, which is about an hour, will take place in the Schulman Auditorium. So don't leave anything here. We're done with this.